lowest reasonable amount. And if you're recording a liability, you should record it at the highest reasonable amount. If there's a question about whether something should be recorded as an expense or an asset, you should record it as an expense. And you should always, when there's an option, you should undervalue rather than overvalue something in the interest of conservatism. We'll see later in this chapter a specific example of how conservatism comes into play when we're dealing with inventory valuation. At the end of each accounting period, we need to determine a value for our ending merchandise inventory. And we also need to determine the cost of goods sold for the period. So to determine our ending merchandise inventory, we can take the number of units on hand times the unit cost. And for our cost of goods sold for the period, we can take the number of units sold times the unit cost. Here's a perpetual inventory record for a particular item in our inventory. So this item happens to be called TAB0503. And if we look at this perpetual record, it tells us on August 1st that we had 2 of these items on hand. We paid $350 for each one. Then on August 5th, we purchased 4 more. We paid $350 for each of those. On August 15th, we sold 4 of the units. On August 26th, we purchased 12 more, paid $350 each for those. And on August 31st, we sold 10 of the units. So we ended up at the end of the month with 4 of the units on hand. Now, because we paid the same amount for each one of the units, $350, it means it's pretty easy to compute both the ending inventory and the cost of goods sold. So ending inventory would be 4 times $350, or in other words, $1,400. Cost of goods sold would be 14 times $350, or $4,900. Now here's a different perpetual inventory record. Notice that in this case, the beginning inventory we paid $350 each for each unit. Then when we purchased more inventory on August 5th, we paid $360 each for those units. And then on August 26th, when we purchased more units, we paid $380 each for those. So the question that arises here is that if we had different amounts that we paid for different units of our inventory, which figures do we use as our cost when we compute our ending inventory and when we compute our cost of goods sold for the period? We're going to find out that there are different methods that we can use to do this, and with some of these methods we use simplifying assumptions to decide what dollar figures are appropriate to use both for our ending inventory and for our cost of goods sold. Here are the 4 inventory costing methods that we're going to study in this chapter. The methods are specific identification, first in, first out, which we call FIFO for short, last in, first out, which we call LIFO for short, and weighted average. Now, the slide said that these are the 4 basic costing methods that are allowed by GAAP. There are actually more than 4 methods that can be used under GAAP. There's a popular method called the retail method that is used by many retailers, but we're not going to be studying the retail method here. The first method that we will look at is the specific identification method. And this method we tend to use if we're selling high dollar value items and we're selling relatively small quantities of them, and there's a way that we can keep track of exactly which items we're selling through often something like serial numbers. So let's assume that our company is a new car dealer, and every car that we sell has a VIN number on it. So when we sell a car, we can look up that VIN number and find out exactly what we paid the factory for that car. And so when we sell it, we can subtract the amount that we paid for that car from our inventory, and we can add the amount that we paid for that car to our cost of goods sold for the period. So we don't need to make any simplifying assumptions in that case, because we know exactly what we paid for that car, and we know exactly which car it is that we just sold. Now, the other three methods that we're going to study, they all make simplifying assumptions. So let's say that our company is a distributor of soft drinks. The soft drink bottles don't have serial numbers on them, and it's not especially important or cost effective to know what we paid for one particular bottle versus another particular bottle of soft drink. It makes the most sense, and it's the most efficient in this case, to simply make some simplifying assumptions about what we paid for these bottles of soft drinks. So the first method that we might use in this case would be the first in, first out method, what we call FIFO. In this case, the assumption that we will make is that we sell the oldest units that we had in inventory. That's why we call it first in, first out. We sell the units that were first in our inventory. Therefore, the units that will be in our ending inventory will be the ones that we purchased most recently. And therefore, the cost of our ending inventory will fairly closely represent what the current replacement cost would be if we went out and purchased that inventory again under current market conditions. Here's a perpetual inventory record where we're going to assume that we use the first in, first out method. On August 1st, we had 2 units in inventory. We paid $350 each for those units. On August 5th, we purchased 4 more units. We paid $360 each for those units. So at the end of the day on August 5th, we have a total of 6 units in inventory. 2 of those units we paid $350 for, and 4 of those units we paid $360 for. Then when we make a sale on August 15th, that's the first place here that it comes into play what inventory costing method we're using. We're using first in, first out. So when we sell 4 units on August 15th, we have to assume that they're the oldest units that we sell. However, we only have 2 of the older units in inventory. So we'll have to assume that we sell those 2 older units. We sell the 2 that we paid $350 for. Therefore, the other 2 that we sell will have to be 2 of the ones that we paid $360 each for. And therefore, what's left in inventory after that sale will be 2 of the units that we purchased more recently that we paid $360 each for. Then on August 26th, we purchased 12 more units. We paid $380 each for those. So now what we have in our inventory is 2 units that we paid $360 for and 12 units that we paid $380 for. Then on August 31st, we sell another 10 units. So again, with FIFO, we assume that we sell the oldest units first. So we will sell 2 of those older units that we paid $360 for. And then the other 8 units that we sell will have to be some of the units that we sold or that we paid $380 each for. And what that will leave us with at the end of the month will be 4 units in inventory that we paid $380 each for. And so then if you look at the totals at the bottom, our total purchases for the month are $6,000. Our cost of goods sold for the month is $5,180. And our inventory on hand at the end of the month is $1,520. Okay, the next method that we're going to look at is last in, first out, what we call LIFO. So this is the opposite of FIFO. So now we're going to assume that we sell the units that we purchased most recently. And the older units that are in our inventory will tend to just stay in our inventory. The oldest units never get sold unless we sell entirely through our inventory in some particular accounting period. So here's what the perpetual inventory record will look like for LIFO. So the lines for August 1st and August 5th are identical to what they looked like before for FIFO because those don't involve any sales. So the first place where this record looks different is on August 15th when we're making a sale. When we sell 4 units on August 15th, now, instead of assuming that we sell the oldest units, we assume that we sell the newest units. Therefore, all 4 units that we sell on August 15th are going to be ones that we paid $360 for most recently. And therefore, what will be left in our ending inventory on August 15th will be those 2 units that were in our beginning inventory that we paid $350 each for. Then we have the additional purchase on August 26th. Then on August 31st, we have an additional sale. So when we sell 10 units on August 31st, we again want to assume here that we sell the newest units. So all 10 units will be ones that we just recently purchased for $380 each. Therefore, at the end of the month, our inventory will consist of the 2 units that we've had in inventory all along that we paid $350 each for, plus 2 of the units that we purchased more recently that we paid $380 each for. Okay, then the final method that we're going to look at is the weighted average method. Now, the rule to remember with this method is that whenever you make a purchase, you have to compute a new weighted average cost. And that weighted average cost is used to compute both your ending inventory and your cost of goods sold. So here, we start out with the same beginning inventory that we had for the other two methods that we were looking at. Then on August 5th, because we're making a purchase, we know that we're going to have to compute a new weighted average cost. On August 1st, our weighted average cost really was $350. But on August 5th, the way we compute our new weighted average cost is we take the total dollars of cost that we have, which is a combination of the $700 from our beginning inventory and the $1,440 that we just purchased. So the total dollars of inventory we have now is $2,140. And then we divide by the total units of inventory. So that's the 2 units that we had in our beginning inventory plus the 4 units that we just purchased. So then $2,140 divided by 6 units gives us a new weighted average cost of $356.67. And then we plug that in here as our unit cost, but it's our new weighted average unit cost. Then when we make a sale on August 15th, we use that weighted average cost that we just computed. So we use it for the cost of goods sold to figure out the total cost of those 4 units that we sold, but we also use it for the inventory on hand. The 2 units that are still in inventory times that weighted average cost that we just computed. Then on August 26th, we make another purchase of 12 units. So again, we have to compute a new weighted average cost. So we add together the $713 from our inventory above, plus our $4,560 from the purchase that we're making. That gives us $5,273. And then we divide by 14 units, which is a combination of the 2 units that we had in inventory, plus the 12 units that we purchased. And then that means we come up with a new weighted average cost of $376.64. And then when we make a sale on August 31st, we use that newly computed weighted average cost to figure out both our cost of goods sold on that date and our inventory on hand on that date. Now, if we compare the different costing methods, if we assume that costs of inventory go up over time because of inflation, then cost of goods sold is going to be higher under LIFO than it is under FIFO. Therefore, net income will be lower under LIFO than under FIFO. And on the balance sheet, FIFO inventory will be the highest and LIFO inventory will be the lowest. Here's an exhibit that shows the income statement effects of the different costing methods. And you really can't compare specific identification to the other methods because it just all depends on the unique circumstances that you're dealing with when you use specific identification. But with the other 3 methods that use these assumptions, you can say that FIFO will always have the highest gross profit. LIFO will always use always have the lowest gross profit, and weighted average will always be somewhere in between FIFO and LIFO. Now, companies that are trying to maximize their cash flow will tend to choose LIFO as their inventory costing method. That's because if you use LIFO, you'll report less net income or less taxable income on your income tax return, and therefore you pay less income tax, therefore your after-tax cash flow will be higher. So companies that are conservatively managed and really want to maximize their cash flow tend to like LIFO. On the other hand, companies that want to impress their shareholders by reporting the highest possible net income on their income statement, regardless of the cash flow effects, they will tend to choose FIFO. So the choice of LIFO or FIFO does tell you something about the philosophy of the management of the company that you're looking at. One more interesting thing to note is that the United States is really the only significant country that allows you to use LIFO. Other countries just don't have LIFO. Another thing to note about it is that you're required in the United States to use the same method on your tax return that you use on your books. You can't use FIFO on your books and LIFO on your tax return, for example. That's different than depreciation, because with depreciation that we'll be studying in Chapter 9, you can use one method on your books and another method on your tax returns. But you have to be consistent in terms of what costing method you use on both your books and your tax returns in the United States. And here's comparing the balance sheet effects of the methods. So FIFO is always going to have the highest ending inventory on the balance sheet. LIFO will have the lowest ending inventory, and the weighted average method will be somewhere in between FIFO and LIFO again. Okay, there's something in GAAP accounting that's called the lower of cost or market rule. And I find the name of this to be kind of confusing, because when I think of market value, I think of usually the price at which a company can sell its products for, but that's not what they mean here by market value. What they mean is replacement cost if you were to replace the company's inventory at the cost at which it can currently be replaced at. So the lower of cost or market rule says that it requires that inventory be reported on the balance sheet at the lower of the inventory's historical cost, or really its current replacement cost. So if you could go and buy that inventory over again today and pay less for it than what you paid historically for it, then you have to make an adjustment to bring it down to what today's cost of that inventory will be. This is an example of the principle of conservatism that we talked about at the beginning of the lecture. So here's an example. It says Smart Touch Learning paid $3,000 for its TAB 0503 inventory. By December 31st, it can be replaced for only $2,200. And the decline in value appears permanent. So they would have to make an adjustment to their balance sheet for this to reduce the carrying value of the inventory by $800. And so the journal entry that they would use to do this would be that they would debit cost of goods sold, $800. They would credit merchandise inventory, $800. We call this writing down the value of the inventory. Now, there's something really odd about the author's wording here because it says the decline in value appears permanent. It actually doesn't make any difference if the decline in value is permanent or not. You could remove that statement and it would still be true. If the cost has come down, you still have to, regardless, write down the value of the inventory. Now, let's say in the next accounting period that the cost of the inventory goes back up. You never write up the value of the inventory. You only write it down. It's a one-way street. You write down, but you don't write up. And again, that's an example of the principle of conservatism. You want to be conservative in the way you report all of your values on the balance sheet. Okay, if you make an error in counting inventory, that can have an effect both on other accounts and on other accounting periods. And what you see shown here on the left side of the screen is basically the formula that we talked about in Chapter 5 for computing cost of goods sold if a company is using the periodic inventory system, where we go through that formula at the end of each accounting period to calculate the cost of goods sold after we've counted the ending merchandise inventory. Now, what we're going to discuss here could be true even if a company is using the perpetual inventory system, because remember, under GAAP accounting, even if you use a perpetual inventory system, once a year you still have to count your inventory because there could be some errors in your accounting system with regard to inventory. So here, when we count the inventory at the end of an accounting period, we overstate the value of our inventory by $5,000. So when we work through that formula that we show there on the left, by subtracting our ending merchandise inventory to come up with cost of goods sold, it means that our cost of goods sold is going to be understated by $5,000. Therefore, our gross profit will be overstated by $5,000, and therefore our net income will also be overstated by $5,000. Now, this has often an effect for more than one accounting period. So notice here in period 1, if inventory was overstated by $5,000 in period 1, ending inventory in period 1, it means that our gross profit in period 1 was $5,000 more than it should have been. But our ending inventory for period 1 becomes our beginning inventory for period 2. Therefore, when you work through the same formula for period 2, the effect is the opposite, and our gross profit for period 2 becomes understated by $5,000. So if you add together period 1 and period 2, the gross profit in total for those two periods is correct at $100,000. The gross profit just gets misallocated between the amount that's in period 1 and the amount that's in period 2. And then if you don't make any additional counting errors with regard to your inventory, everything should be correct from that point going forward. Okay. So an error like this will generally have an effect for 2 accounting periods. There are 2 ratios at the end of the chapter that deal with inventory. And the first ratio is called the inventory turnover ratio. It measures how rapidly a company is able to sell its inventory. And so generally a higher turnover ratio is better. If the turnover rate is too low, it indicates the company is having a hard time selling its inventory. So the formula for the inventory turnover ratio is you take cost of goods sold divided by the average merchandise inventory. And when we say average merchandise inventory, we take the beginning inventory plus the ending inventory and then divide by 2 to get a simple average. And we'll, in a couple minutes, we'll look at examples of these ratios for Kohl's Corporation. Then once we've calculated the inventory turnover ratio, we can calculate a related ratio, which is days sales and inventory. So for this ratio, we just take 365 days divided by the inventory turnover ratio. So for this ratio, we prefer to have a lower number to show that it's we're able to sell our inventory relatively quickly. So now looking at Kohl's, these numbers are kind of old now, but Kohl's inventory turnover ratio was 3.12. So it means that about 3 times a year, Kohl's sells through the inventory that they have on their shelves, and then that gets replaced with new inventory that they have purchased. And then for days sales and inventory, it would be 117 days. So on average, it's taking them 117 days to sell their inventory. These would both be fairly typical ratios for retailers that are clothing oriented or department store type retailers. If you were to look at these ratios for Publix, they would be much different because with Publix, if they're selling things like milk and eggs, they can't keep them in inventory for 117 days. Obviously, they would go bad. So you would expect, if it's a grocer, that these ratios would be a lot different than this. Okay, then there's an appendix to this chapter. This appendix deals with the periodic inventory system. Just like in chapter 5, we had an appendix that dealt with the periodic inventory system. So here's a perpetual inventory record that we saw near the beginning of this lecture, but we're going to use the data from this record to show how we would calculate the cost of goods sold and the ending inventory if we're using a periodic inventory system. First of all, if we're using the first in, first out method, FIFO, it's basically the same concept of computing both ending inventory and cost of goods sold, but it's a little bit easier to do when we're using periodic inventory because we don't have to have a separate transaction line for every date that we have a transaction during the month. Instead, we can group all of our transactions together. So notice here, there's one line that says net cost of purchases. So even though you may have had purchases on a number of different dates during the month, you can put them all on one line. So we purchased 4 units at $360, and we purchased 12 units at $380. And then in this case, for ending merchandise inventory, it happens that we have just 4 units at $380, but in some cases you would have more than $1 figure that you would have to include in your ending merchandise inventory. Another thing that makes this easier compared to the perpetual system is that we don't have to make a separate computation really of cost of goods sold. All we have to do is, we compute cost of goods available for sale, and what that term means is it's the combination of beginning inventory plus purchases. And then when we subtract ending merchandise inventory from cost of goods available for sale, it gives us cost of goods sold. So we could have gone through a separate computation where we said cost of goods sold is, 3 units at $360 and 4 units at $380, etc. But we don't have to go through all of those computations because it's much easier in this case to simply subtract to get cost of goods sold. And we will go through a problem together in my accounting lab with the periodic system. So you'll get a better feel for how we do this. Now, notice the note at the bottom of the screen. Regardless of whether you're using perpetual inventory or periodic inventory, if it's FIFO, your cost of goods sold and your ending inventory are going to turn out to be the same dollar figures. However, that's only true of FIFO. With LIFO and with weighted average, you will get different results depending on whether the company uses a perpetual inventory system or a periodic inventory system. Okay, here's doing last in, first out with a periodic inventory system. So notice here when they subtract ending merchandise inventory, there are two different costs included in the ending merchandise inventory. So it was 2 units at $350 and 2 units at $360. But again, if we simply subtract the ending merchandise inventory, we get the cost of goods sold without having to do a separate calculation, really, of cost of goods sold. Then weighted average, when we were discussing weighted average before, we said there's a rule that every time you make a purchase, you have to calculate a new weighted average. Well, that's not true here. That's only with a perpetual system. So if you're using a periodic system, then you only calculate one weighted average for the entire period. And that's what they're doing here up towards the top of the exhibit. So you take the cost of goods available for sale, which is the $6,700 figure, and again, that's the combination of your beginning inventory and your purchases. And then you divide that by the number of units available for sale, which is the number of units in your beginning inventory plus the number of units that you purchased. So in this example, you get a weighted average cost of $372.22. Then when we're computing the ending merchandise inventory, that's the figure that we use to compute that. And that's actually the same weighted average cost that applies to cost of goods sold, but we don't have to make a separate computation of that for cost of goods sold because it's just much easier to subtract to get what your cost of goods sold would be for the period here. That was the end of that. Okay, I'm gonna go back to my accounting lab. Go through a few multiple choice problems, and then we'll take a short break before we do the exercise type problems. Okay, which of the following inventory costing methods is based on the actual cost of each particular unit in inventory?
Identification.
Yeah, yes, specific identification. All the other three use assumptions. Oh, okay. This is going to be kind of a difficult one. The question is, what would be reported as cost of goods sold on the income statement? They're using perpetual inventory system and first in, first out. Well, since they're using FIFO, it will simplify it if we ignore the fact that they say it's a perpetual inventory system and just solve it as though they're using a periodic inventory system instead. So, cost of goods sold. So we know, first of all, the number of units they sold would have been 195 in one sale and 70 in another sale. So they sold 265 units. And first in, first out, so they would have sold 125 of the older units that were $80 each. And then the rest of the units would have to be ones that they paid $85 each for later on. So 265 units in total they sold, but we already accounted for 125 of them. So now we're going to account for the difference at $85. And then add these two numbers together. So 21,900 should be our cost of goods sold. Okay, which of the following statements regarding FIFO is incorrect?
B as in dog.
Yeah. It's not a specific identification method. By the way, it is consistent with the physical movement of inventory for most companies. Think of Publix. If you're buying milk at Publix, they move the older milk towards the front of the shelf to get you to buy that. If the newer milk were at the front of the shelf, then the milk at the back of the shelf would eventually go bad and they'd have to throw it out. So they want the older milk to be near the front. So that's an example of first in, first out. It doesn't mean that they have to use first in, first out for their accounting. They can use whatever inventory costing method they want, but it just happens that the way the physical flow works tends to be first in, first out. Here's another one that involves some computations, I think. So they purchased 400 units on January 31st. They purchased 100 units on February 28th. They sold 150 units during between March and December. They used last in, first out. We're supposed to calculate the cost of ending inventory on December 31st. So the number of units in inventory, we would take the 400 that they purchased plus the 100 that they purchased minus the 150 that they sold. So they have 350 units in their ending inventory. And last in, first out. So it's the older units that are going to be in their ending inventory. So we just take that figure times the $30 that they paid for the oldest units, since they had 400 of those. So it should be 10,500. Okay. Second Street Inc. has 6 units in ending merchandise inventory on December 31st. The units were purchased in November for $200 each. The price lists from suppliers indicate the current replacement cost of the item to be $194 each. Which of the following statements is true of the effects of the adjustments to ending inventory and the cost of goods sold? They have 6 of these units, and the cost per unit has gone down by $6 each since they purchased them. So 6 times 6, it's in total their cost would go down by $36. The journal entry would be cost of goods sold would be debited $36, inventory would be credited $36. So which of these would be true?
It will increase.
Yeah, cost of goods sold would increase by $36, inventory would decrease by $36. Okay, the ending merchandise inventory for the current accounting period, is understated by $2,700. What effect will this error have on cost of goods sold and net income for the current accounting period? Which one?
B.
B is boy?
Yes.
I think that's right. Yeah, cost of goods sold will be overstated, therefore net income will be understated. Okay, that gets us to the exercise type problem. So let's take a 10-minute break and then we'll continue on with that when we come back.